After hours, the trading period after the regular stock market closes, often referred to as the stock market's after party. Traders are still making deals, but with fewer participants and less activity. Asset, anything of value owned by an individual or company. Alpha, measures how much better or worse your investment performs compared to what was expected, considering its risk level. It's akin to running a race with different handicaps. If you finish well ahead of your expected position, you've achieved positive alpha. In investing, this means your portfolio outperformed the market after adjusting for the risk taken. Beta, measures how much a stock's price moves relative to the market. It's the responsiveness of your car's handling. A high beta means sharp reactions to every turn or the market change, akin to a sports car on a winding road. A low beta resembles a heavy, stable vehicle smoothing out the ride. Beta neutral is kind of like a low-flying helicopter. You will still feel turbulence, but it doesn't have anything to do with the highway bumps below. Bid-ask spread, the gap between what buyers are willing to pay, bid, and sellers are willing to accept, the ask. Imagine selling a house. The buyer offers $380,000, that's the bid, but you're asking $400,000 to sell it, the ask. The $20,000 difference is the spread, reflecting the negotiation gap. Blue chip stocks, shares in large, reputable companies known for stability and reliability, such as Apple, Coca-Cola, and Johnson & Johnson. Bond, a loan to a company or government with periodic interest payments and the return of the principal at maturity. It's a formal agreement with a steady return. Broker, an intermediary who buys and sells securities for clients like a personal shopper in the stock market. Bull market, a period of rising stock prices that make it feel like you've hit the jackpot. Imagine upgrading from a kiddie pool party to a champagne-filled jacuzzi on a yacht, complete with a live DJ, fireworks, and a helicopter entrance. Everyone's celebrating, and even your dog is wearing a gold chain. Spoiler, the party doesn't last forever. Then we've got the bear market. Stock prices go into meltdown, officially 20% or larger declines. Your yacht runs aground and you're left clinging to an inflatable flamingo pool float. All the caviar is gone and all that's left is an old case of Spam. It's hard to tell if the salt on your face is from seawater or your streaming tears. Meanwhile, the shorts are like great whites, eagerly snatching up your sinking treasures. If you want to learn tricks to avoid becoming shark bait, like this video and help educate more people and keep this ship afloat. Close, the final price of a security at the end of the trading day, typically at 4 p.m. Eastern Time or earlier on holidays like Christmas Eve. Dark pool, private exchanges where big players make anonymous trades without spooking the market. Think of it as a secret VIP room in a nightclub where the big deals go down. But don't worry, it's totally legal. Day trading, buying and selling securities within the same day for short-term gains, moving in and out of trades rapidly to capitalize on price fluctuations. Dilution occurs when a company issues new shares, increasing the total but weakening each existing share's value. It's like adding water to your vodka tonic. Dividends, payments from a company to shareholders from profits, often quarterly, like a thank you note for holding the stock, often with favorable tax treatment. Earnings per share, a company's profit divided by the number of outstanding shares. ETFs, investment funds traded on stock exchanges offering a diverse mix in one purchase, similar to a playlist of songs. Fundamental analysis, evaluating a company's financial health and intrinsic value through financial statements and market conditions, similar to a detective solving a case. This was how I got my start learning fundamental analysis and value investing. Going long, buying a stock in the traditional way, expecting its price to rise. If the stock soars, you profit. If it falls, losses can be severe, but you're hoping for long-term gains. High, the highest price a security reaches during a trading period, usually the peak of the day's trading. Holdings, the various assets or securities in an investor's portfolio, like a collection of all your investments. Index, measures the performance of a group of stocks representing a market snapshot at a specific time. To invest in the stocks within an index like the S&P 500, which includes the 500 largest publicly traded companies on the New York Stock Exchange and NASDAQ, you can buy mutual funds or ETFs like SPY, VOO, or IBV, which hold the basket of stocks in the index. IPO, initial public offering, the first sale of a company's stock to the public, allowing investors to buy shares. The goal is to raise maximum funds, but be cautious. You often overpay, similar to buying the first round of tickets to a blockbuster movie premiere. Everyone wants in, and prices can be steep. Last, the most recent price at which a security was traded. Leverage, Using borrowed funds to increase investment returns, which can magnify both gains and losses. It's like turning up the volume on a stereo. If the song is good, it sounds better. If it's bad, it sounds a hell of a lot worse. Liquidity measures how easily an asset can be converted into cash without affecting its market price. It's the difference between selling a high-demand item like a concert ticket versus a rare collectible. Liquidity is the speed and ease of selling. Low, the lowest price at which a security trades during a given period. Usually the day's low. It's the valley and the mountain range of a trading day. Market cap, the total value of a company's outstanding shares reflecting the company's worth. Market order, an instruction to buy or sell a security immediately at the best available price. Execution is guaranteed, but the price is not. It's like grabbing the best available seat at a concert without negotiating. You ensure you get in, but the price could fluctuate. Open, the price of a security at the start of the trading day, typically at 9:30 a.m. Eastern Time. PB ratio compares a company's market value to its book value, which is assets minus liabilities. Think of it as comparing the market price of a house, including land, to its construction and land costs. If the house sells for more than these costs, it has a high PB ratio. PE ratio compares a company's share price to its earnings per share, similar to evaluating a rental property based on its net income. If you buy a property for $200,000 and it nets $10,000 annually after expenses, the PE ratio would be 20, meaning you're paying $20 for every $1 of earnings. PEG ratio compares a company's PE ratio to its expected earnings growth rate. A lower PEG ratio can indicate a potentially better deal, suggesting higher growth at a reasonable price. It's like buying a rental property in a booming market. If the property is expected to increase in value quickly, the investment becomes more attractive, making the PEG ratio lower and more appealing. Portfolio, a collection of investments owned by an individual or institution. For example, if you own shares of stock in a Fidelity account, all your holdings in that account make up your portfolio. Pre-market, trading begins before the regular market opens, typically starting at 4 a.m. Eastern Time. It's the early morning coffee run, allowing traders to get a jump on the day's action before the regular session starts at 9:30 a.m. Proxy, an authority to act on behalf of a shareholder for voting purposes, like having someone vote for you at a company meeting, similar to sending a representative to make decisions. PS, price sales ratio, compares a company's stock price to its revenues, useful for valuing new companies that have sales but aren't yet profitable. It gauges how much investors are willing to pay for each dollar of sales. Public company, a company whose shares are traded publicly on a stock exchange, meaning the general public can buy and sell its shares, participating in the company's financial successes and risks. Quandamental Analysis combines quantitative and fundamental methods to evaluate a stock's value, using both data analytics and financial statements to get a comprehensive view of an investment's potential. Quantitative Analysis uses mathematical models and algorithms to analyze data and predict market trends. It's more science than art, similar to a meteorologist forecasting the weather based on data. REIT, Real Estate Investment Trust, a company that owns, operates, or finances income-generating real estate. You can invest in REITs on the stock exchange, gaining exposure to the real estate market without directly buying property. Return on investment, ROI, a measure of the profitability of an investment, often expressed as a percentage. Similar to flipping a house for $300,000 after you invest $200,000, giving you an ROI of $100,000 or 50%. Shareholder, an individual or entity that owns shares in a company and can vote on company decisions. If you buy 10 shares of Apple stock, congratulations, you are now an Apple shareholder. Shorting or short selling, borrowing shares of stock and selling them, hoping to buy them back later at a lower price. You profit if the stock price drops, but must pay interest for borrowing the shares. If the stock price rises, you lose money because you have to buy the shares back at a higher price. Stock represents a share of ownership in a company. The more shares you own, the larger your stake in the company and the more dividends you might receive. A stock story, the YouTube channel you're watching right now. If you want to understand the stock market, learn about trading systems that can take the emotions out of investing, and also think learning about investing should be a good time, then save yourself a whole lot of headache by clicking the subscribe button right now. Your future self will thank you. Stop limit order. A stop limit order is a buy or sell order that sets two prices, a stop price, which triggers the order, and a limit price, which is the maximum or minimum you're willing to accept. However, there's no guarantee the order will be filled if the market's price moves away from your limit price before the transaction can be executed. Stop loss order automatically triggers a market order to sell your stock if it hits the stop price, potentially limiting losses. Like a market order, execution is guaranteed if the stop loss is hit, but the exact sale price is not. Swing trading, a short-term strategy where investors hold securities for days or weeks to capitalize on expected price changes. Systematic trading, using fixed, predefined rules to make trading decisions, which can be done manually or automatically. This takes the emotion out of investing. Technical analysis involves studying past market data, primarily price and volume, to predict future price movements. Common patterns include head and shoulders, double bottoms, and cup and handle, which traders use to identify potential trading opportunities. Technofundamental Analysis, combining technical and fundamental analysis to form a holistic market strategy. Ticker, a unique series of letters assigned to a publicly traded company on a stock exchange, used by investors to quickly identify and trade stocks. Examples include AAPL for Apple, TSLA for Tesla, and MSFT for Microsoft. Trading algorithm, a set of computer-coded instructions to automate trading decisions. Trading bot, automated software that executes trades based on predefined criteria. Trailing stop loss, a stop loss order that adjusts with the stock's price, allowing you to lock in profits as the price rises. For example, if you set a trailing stop loss at 5% and the stock price moves from 100 up to 120, the stop loss moves up to 114. This type of order can potentially protect gains without you having to constantly monitor it. Volume measures the number of shares or contracts traded in a security or market during a specific period, typically shown as a 1-day or 3-month average. High volume indicates strong interest, while low volume suggests less activity. Volatility refers to the degree of variation in a stock's price over time, indicating the level of risk. Higher volatility means bigger price swings, leading to higher potential rewards, but also greater risk. If you haven't subscribed yet, now's the perfect time, so click that button and join the community.